Hey everybody, welcome back to the channel. If you're new here, I'm Your Name, and I make videos about smart ways to build wealth, especially for everyday investors, in Australia or beyond. Today we are diving deep into how Australian investors can use ETFs and LICs to build safe, long-term growth, without chasing risky stuff. Now, before you click away thinking, oh, boring finance, hear me out. This is the kind of strategy that can let you sleep at night and compound real returns over decades. We're going to compare ETFs versus LICs, talk about where each shines, show real examples in the Australian market, and then build a simple portfolio you could actually implement. By the end of this video, you'll understand what ETFs and LICs really are, beyond buzzwords. The pros, cons, tax implications, and structural quirks. How to pick the best ones in Australia. How to blend them into a safe growth portfolio. Concrete examples you can follow. So if you like content that's practical, no fluff, and grounded in real numbers, hit the like button now, subscribe if you haven't, and let's jump in. Cut to title slide, Australian investors, how to use ETFs and LICs for safe growth. ETFs, the low-cost workhorse. Let's start simple. ETF stands for Exchange Traded Fund. In Australia, ETFs are managed funds structured as trusts, and you buy units rather than shares. Here's how they work. The ETF provider owns a basket of underlying assets, e.g. ASX 200 stocks, international equities, bonds, commodities. When you invest, you're buying units of that trust, not the actual underlying shares. New units can be created or redeemed on demand, which helps the unit price stay close to the net asset value, NAV, of the underlying portfolio. Most Australian ETFs are passively managed. They simply follow a benchmark like ASX 200, S&P 500, or sector indices. There are also active ETFs or exchange-traded managed funds which try to beat the market, though they are less common. Pros, quick list. Low cost, because passive. Transparency, you often see daily holdings and NAV info. Liquidity, you can trade them easily during market hours. Diversification, one trade gives you access to many assets. Flexibility, can cover sectors, international markets, bonds, commodities. Cons are risks. Tracking error, your returns might deviate slightly from the index. Market risk, if the underlying index falls, you lose too. Currency risk, for international ETFs, fluctuations in AUD versus USD, and less hedged. Liquidity, trading spreads, some ETFs are thinly traded. Passive nature, you won't outperform the market, you match it, minus costs. LICs, the active, closed-end vehicle. LIC equals listed investment company. Unlike ETFs, LICs are structured as companies. You buy shares, not units. Key structural differences. Closed-end, the total number of shares is fixed unless the LIC issues new shares or does buybacks. You can't enter or exit by creating or redeeming new shares. Buying or selling happens between investors. Actively managed, the fund manager picks companies, times entries, exits, etc. It's not just tracking an index. Because of that, LICs can trade at a premium or discount to their net tangible assets, NTA, i.e. the value of their underlying holdings. So sometimes the share price is lower, discount, or higher, premium, than what the assets are worth. LICs can retain profits, smooth payouts, build reserves. They have more flexibility in timing distributions. LICs also follow corporate governance, board, shareholders, meetings, because they are companies. Pros. Potential to outperform via active management. Ability to smooth dividends, i.e. buffer against volatility. Trading at discount gives margin of safety if discount closes. Franking credits, LICs can pay fully franked dividends, which is attractive to Australian investors, especially those in low tax brackets. Cons are risks. The discount might never close. So you might buy at a discount that persists. Because they trade like shares, market sentiment can heavily influence price, beyond the underlying assets. Costs: active management means higher fees, possibly performance fees, plus the overhead of a company structure. Less transparency: LICs often report holdings less frequently, quarterly, rather than daily. So it's not that one is better than the other, they suit different investor preferences and risk tolerances. If you prefer low cost, set and forget, ETFs are compelling. If you believe in skilled active managers, want flexibility in payout, and are okay with paying for it, LICs can add value. This is where things get interesting, because the quirks of LICs give both risk and opportunity. If you understand this thoroughly, you can tilt the odds in your favor. What is NTA and net tangible assets? NTA equals value of all the LIC's assets, liabilities, intangible assets. In simple terms, what the underlying holdings are worth per share. It's akin to book value. It's what the company should be worth if it liquidated its assets, ignoring magic. LICs publish their NTA, often quarterly or monthly, so investors can see how far the share price diverges from the intrinsic value. Discount premium. Discount: the share price trades below NTA. E.g., LIC has NTA of $1 per share, but market price is 80 cents, 20% discount. Premium: share price trades above NTA. Less common, but can happen if market expects manager to add value. That divergence arises because LIC shares are traded like normal stocks. If investor sentiment is weak, or the LIC is unpopular, or it's illiquid, it may trade at wide discount. The reverse if highly sought after. Why is this important? If you buy an LIC at a 25% discount, and over time the discount narrows, i.e. price moves closer to NTA, you get an extra tailwind. But if the discount widens further, you might lose. Also, fees are charged on asset base, NTA, not on market price. So if discount remains, effectively your fee as a percentage of your cost is higher. E.g., you buy at 80 cents but pay fees on the NTA of $1, so your effective fee is fee divided by 0.80, rather than fee divided by 1.00. This is a sneaky drag. Strategies around discount premium. Buy at discounts: some investors intentionally look for LICs trading at wide discounts, assuming the gap will close. Favor stable or narrowing discounts: focus on LICs which historically maintain small discount or sometimes trade at premium. Avoid those with persistently large, widening discounts, could be structural issues, low liquidity, poor reputation. Watch for conversions: some LICs convert into ETFs to eliminate discount issues. In fact, in Australia, there's been a trend of LIC ETF conversions when discounts get painful. Real-world Aussie cases. There are many LICs listed on the ASX, e.g. Argo Investments, AFIC, Australian Foundation Investment Company, that have long histories, stable dividend policies, and sometimes trade close to NTA. However, in recent years, some smaller LICs have seen discounts widen to historical extremes, which has led investors to question their viability. Some major fund managers have converted their LICs to ETFs to resolve the discount issue. Australians have a unique tax environment with dividend imputation franking credits, and that changes how LICs, ETFs behave. How dividends and franking credits work. Quick recap. Many Australian companies pay fully franked dividends, i.e. tax is paid at corporate level, and investors receive franking credits to offset tax owed. For instance, a company pays a $70 dividend but pays $30 in tax. The full grossed-up dividend is $100, and the investor can claim the $30 credit. LICs and ETFs pass these franked dividends through, in different ways, so they can return tax credits to you. But the structure matters. ETFs and tax. ETFs are flow-through vehicles, meaning dividends and capital gains generated by the ETF's portfolio must be distributed to investors. If the underlying holdings generate franked dividends, those flow through, plus credits, to you. Capital gains: if the ETF sells assets at a gain, it passes that gain through, and if held for more than 12 months, you may qualify for the 50% CGT, capital gains tax, a discount, subject to your tax bracket. Because distributions may be lumpy, depending on trades, your tax bill can vary year to year. LICs and tax distributions. As a company, LICs collect dividends and capital gains, pay company tax, and then decide on the timing and amount of distribution. This allows LICs to smooth distributions in bad years, i.e. retain profits. LICs can distribute franked dividends. Some LICs even distribute full franking credits depending on underlying portfolio yields. Because of the corporate structure, the timing of tax events can be managed inside, giving some flexibility. But those retained profits or reserves can complicate tax calculations. Key takeaways for Australian investors. If your marginal tax rate is low, fully franked dividends and franking credits make Australian equities via ETF or LIC quite attractive. Beware of timing risk in ETFs where big gains are distributed in a year you have high income. LIC's ability to smooth may be an advantage in bad tax years. Always check the product disclosure statement, PDS, or annual reports for how distributions are handled, how frank they are, and frequency. Now we get to the fun part, how to actually use these tools for consistent, low-stress growth. Investment mindset and risk tolerance. First, define your goal. Safe growth doesn't mean zero risk. It means managing risk while achieving above-inflation returns over decades. You need to decide what portion of your capital you're comfortable exposing to equities vs fixed income, bonds, cash. How much active risk you accept, i.e. via LICs vs passive baseline. How long you plan to hold, 15 plus years is ideal. Whether dividend income is crucial, e.g. for retirees, or you're maximizing total return. Core satellite allocation approach. One way to structure a safe growth portfolio is core, base ETFs, low cost, diversified, passive exposure. Satellite, tilt LICs active choices to try capture extra returns or exploit discounts. For example, 60 to 70% in broad-based Australian plus global ETFs. 20 to 30% in trusted LICs that have shown consistent performance. 10% in tactical sector ETFs or LICs, e.g. infrastructure, thematic, smaller active bets. Cash bonds a fixed income buffer. You can adjust based on age, risk profile, etc. Sample portfolios, Australian investor example. These are illustrative, not financial advice. Portfolio A, balanced safe growth. 40% ASX 200 ETF. 20% global ETF, e.g. MSCI World x Australia. 15% Australian bond fixed income ETF. 15% in 2 to 3 LICs, with strong track record. 10% sector or thematic ETF, e.g. infrastructure, healthcare. Portfolio B, more aggressive tilt. 50% global ETF. 25% Australian equities ETF. 10% Australian bond fixed income. 10% LICs. 5% small cap high risk ETFs or LICs. Selecting ETFs and LICs, criteria to use. Here's a checklist you should run through when picking. For ETFs, expense ratio MER total fees. Liquidity, bid-ask spread. Tracking error, how closely it follows the index. Underlying index, what you're getting exposure to. Currency hedging, for international ones. Provider reputation, transparency. For LICs, historical discount premium patterns. Quality and reputation of the manager. Dividend history and franking. Cost structure, management fees, performance fees, overheads. Liquidity of the LIC, volume. Governance, board quality. Assets under management, too small equals risky. Rebalancing and managing over time. Set a rebalance schedule, e.g. annually or semi-annually. When a LIC's discount gets absurdly wide or narrow, consider trimming or rebalancing. Make your tilt bets modest, you don't want the satellite positions to dominate risk. Always track total costs, brokerage, spreads, fees, they eat into performance. Risk controls and guardrails. Don't overconcentrate in one LIC or one sector. Beware illiquid small LICs, they might have huge gaps. Use limit orders when trading ETFs and LICs, not market orders. Maintain some exposure to bonds of defensive assets. Use dollar cost averaging, buy in bits over time, rather than trying to time the market. To ground this in reality, we'll look at real LICs ETFs in Australia, how they've performed, and what lessons we can draw. Popular Australian ETFs. VAS, Vanguard Australian Shares Index ETF, tracks ASX 300 ASX 200, core Aussie exposure. VGS, Vanguard MSCI Index International ETF, Global Developed ex-Australia. VGE, VTS, etc., other global, emerging, sector funds. Bond ETFs e.g. Vanguard Australian Fixed Interest ETF, etc. These are good building blocks, low cost, high liquidity, strong providers. Popular LICs in Australia. Some well-known ones. AFIC, Australian Foundation Investment Company, one of the longest-standing LICs. Argo Investments, ARG, another long-established LIC. Others more specialized or newer ones. We'd examine their discount history, dividend track record, and performance versus benchmarks. Case study, AFIC. Show how AFIC's NTA versus share price has behaved over last 10 years. How dividends franking credits added to total return. How it compared to ASX index or a comparable ETF. Case study, a LIC with wide discount. Choose a LIC that's currently trading at a wide discount. Show why it got that way, maybe low investor interest, poor track record. Show what went wrong, or whether it recovered. Lesson, the conversion of LICs to ETFs. Some LICs have converted to ETFs to avoid discount problems. This is happening in Aussie markets. Advantages. Removes discount risk, simplifies structure. Disadvantages, you lose the ability to lose potential arbitrage opportunities. Now that you know the theory, here's how to get started, step by step. Step-by-step execution plan. Define your risk tolerance and goals. Are you seeking income, growth, or a blend? Decide your core allocation, e.g. 70% ETFs, 20% LICs, 10% tactical. Screen ETFs and LICs using the checklist above. Open a brokerage account with access to ASX markets. Buy in tranches, dollar cost average. Set alerts, watch discount levels on LICs. Rebalance periodically. Monitor dividends, tax implications, and costs. If you have a personal brand, financial coaching, or a course, here you can insert a soft CTA. For example, if you want help picking which ETFs or LICs are right for you, I run a private community or course where I walk through real portfolio builds, reviews, and live Q&A. Join via the link below. Also prompt the viewers. Drop in the comments which LIC or ETF you're watching right now. If you enjoyed this deep dive, hit like, share with someone investing in Australia, and subscribe. We've got more content coming. Remind them, no investment is zero risk, but using ETFs plus LICs intelligently gives you a robust, semi-passive path. Emphasis, consistency, patience, and low-cost dominance win in the long run. Tell them what's next. In the next video, I'll compare this portfolio vs investing in individual shares, which is better for Aussie investors.